Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this video, we will try to understand where we have the highest probabilities for a potential move on this pair. And the way in which we will be doing that is first, analyzing the pair from a technical perspective. Then we will go and see what we have when it comes to the commitment of traders, which is what hedge funds and the non-commercials, so the biggest speculators in the market, are doing. So without wasting any more time, let's go straight to the charts. In today's video, I want to speak about EURCHF. In fact, we do have quite interesting price action and structure on it. So let's get straight into the analysis. Starting here on the monthly, what we can see is that in all this impulse to the downside, there is one candle not related to the move. Now that candle is exactly this green one here, indicating that while the market had very strong bearish momentum, it anyway reacted to this zone, creating this bullish rejection. So we do have very strong previous support turn resistance at this zone, which the market has broken through the downside and is currently retesting. And in fact, we can see how we have already started rejecting this area as resistance. Dropping down on the weekly, what do we see? Now, from a weekly perspective, we can see how the market at the moment is starting to print a series of higher lows. Starting from here, we had the first low, higher low, and now we do have the possibility to create another higher low at this area. We can also notice how, by looking at the structure, this zone is the historical structure level for this market, acting as support here, again here. The market then broke it to the downside at that point. This previous support was turned resistance here, again resistance here. And since we are currently approaching it from above, this is supposed to act now as support. Therefore, we could expect a potential rejection higher. If we go down on the daily time frame, what do we see? Now, from a daily perspective, this is where things start getting quite interesting. We can see how in creating this move to the downside, the market also printed an M pattern. Now, as I said many times, after the creation of an M pattern, what we could potentially expect is for the market to create a rejection higher for the completion of the pattern at the previous support turned resistance. So here on the daily, what we could expect is this potential short-term rejection to the upside for the completion of the pattern at this previous support turned resistance. Now, in general, if you have an impulse and you want to measure the potential correction, what you have to do is take your Fibonacci from the high to the low of the impulse. And if we do that, we can see how we have the 0.32 and 50% Fibonacci retracements currently lining up with this previous support and resistance, creating a very strong supply zone here that the market could definitely decide to go and test. Now, if we go and check the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market, are doing, and we check the data for the CHF, we can see how the CHF is actually getting quite weak at the moment, going from an already negative net positioning of minus 5.2k net positions all the way down to having now minus 15.7k net positions, with 2.2k shorts added with the last report, reaching 20.4k shorts compared to only 4.7k longs, making the CHF quite weak. And if we go and see what we have on the euro, we can see how the euro did have a decrease of the net positions in the long run. However, in the short term, we went from negative to positive. In fact, we went from having more shorts than longs to now having more longs than shorts from an institutional perspective on the euro. So what we could easily expect is short-term strength of the euro and short-term weakness of the CHF, which is exactly what we need if we are to create this rejection to the upside, completing the pattern at the neckline. So how we could be approaching this potential move to the upside. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily combined with the CO2 data, those are the best timeframes from a directional perspective. However, when it comes to confirmations and entries, the best timeframes are the intraday timeframes. So 4 hour, and lower. Therefore, what we could be doing is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we would have to an intraday bullish market. And if the market would shift from an intraday bearish to bullish market and provide to us one of our valid entries, we could be looking for this potential move to the upside and completion of the pattern at the neckline. Now, if you don't know what I'm speaking about when I say market environment shift and valid entries, that is all part of the mentorship program, which you can now access completely for free. In fact, the link is in the description, and I really suggest that you go and check it out because you can learn all the rules of the strategies and you will find a lot of valuable content inside of it. Now, if you enjoyed this video, also make sure to smash that like button and comment below. It really does support the creation of more free education analysis for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.